Hello and welcome to Know and Grow with Mubashir Jelani, where we simplify money matters and help you take smart steps towards financial freedom. Today's topic is how to protect your wealth during a market downturn. Something every serious investor must think about, especially if you are an expat living in the GCC. Whether you are in Qatar, UAE, Saudi, or anywhere else in the region, the global markets affect all of us. Economic downturns come and go. It's part of the natural cycle. But smart investors don't just sit and hope for the best. They prepare in advance. And that's exactly what we are going to talk about today. Simple, proven strategies to protect and grow your wealth when markets get rough. Why you need a defensive wealth strategy. Let's start with the most important mindset shift. In good times, it's easy to invest, but during a market crash or recession, many investors panic, sell at a loss, and regret it later. So you need a defensive strategy, especially if you rely on your investments for income or if you're close to retirement. The goal is not just to avoid losing money, but to keep your financial plan intact, protect your cash flow, and position your portfolio for long-term success. And that requires some active planning. Diversification, your first line of defense. The first and most powerful tool is diversification. That means not putting all your eggs in one basket. Spread your investments across stocks, bonds, real estate, cash, and even commodities. For example, when stocks go down, sometimes bonds or gold go up. That helps balancing the things. You can also diversify across countries, so you're not only tied to one region. Sectors like tech, healthcare, energy, utilities, company sizes, for example, large cap, small cap. If you are in GCC, look beyond just regional real estate or local stock exchanges. Explore global mutual funds or ETFs through international brokerage accounts that are accessible to expats. For example, Interactive Brokers, Serva. Diversification doesn't remove all risk, but it reduces the impact. When one area of the market suffers, the other can recover. Next is something called tactical asset allocation. This simply means adjusting your portfolio based on the current economic situation. Let's say things are looking shaky, high inflation, rising interest rates, or geopolitical tensions. In that case, you might want to reduce your exposure to high risk growth stocks and move towards defensive sectors like utilities or consumer staples or farm, or even increase your bond or cash positions. Then when the market starts recovering, you reallocate back to growth assets to benefit from the upside. You don't have to do that every week, but keeping an eye on the big picture and making a few smart shifts can really protect your portfolio. Here's a smart strategy many investors miss: tax loss harvesting. If you have investments that have gone down in value, you can sell them to realize a loss and use that loss to offset the gain elsewhere in your portfolio. This can lower your taxable income, especially useful if you're investing in the US or other taxable jurisdictions. You can then reinvest in a similar asset to stay in the market. Just make sure it's not too similar to avoid wash sales rules. This strategy is especially useful during a downturn because temporary losses can become long-term tax savings, protecting your income stream. If you depend on your portfolio for regular income, for example, to support your family while living abroad, it's even more important to protect your income sources. Here are some options: dividend paying stocks in strong sectors, high grade bonds that give steady interest, municipal bonds if you are based in the US, or even annuities or structured products that offer guaranteed payouts. The idea is to have reliable cash flow so you don't have to sell your investments at a loss just to cover your expenses. Now let's talk about something very practical: liquidity. Always keep some cash or cash equivalent investments aside. A good rule is to have 6 to 12 months of living expenses in a low risk, easy access account. Why is this important? Because when market crashes, having cash gives you breathing space. You don't need to touch your long-term investments, and you might even find great buying opportunities when prices are low. In the GCC, this might mean keeping part of your money in Islamic money market funds or short-term sukuks if you prefer Sharia compliant options. Control emotions. During downturns, emotions run high, fear takes over, people panic, sell everything, and regret it later. This is where discipline matters more than anything else. Stick to your long-term plan. Don't try to time the market. Work with trusted financial advisor if needed, or someone who can give you perspective. Also, rebalancing your portfolio during dips rather than reacting emotionally can help you buy low and sell high over time. Remember, every major market crash in history has eventually recovered. So don't let short-term fear damage your long-term future. Stress test your financial plan. Finally, do a stress test on your financial plan. Ask yourself, what if the market drops 30%? What if inflation stays high? What if interest rates shoot up? What if I lose part of my income? These aren't fun questions, but thinking about them now will help you find weak spots in your plan and fix them before anything goes wrong. To sum up, markets downturns are part of the journey, but with small planning, diversification, income protection, tax efficiency, liquidity, and emotional control, you can protect your wealth and come out stronger. If you found this video helpful, don't forget to like, subscribe, and share it with fellow expats in the GCC. And if you have questions about your portfolio or want a personalized investment strategy, feel free to drop a quick comment or reach out. I'll be happy to help you. Until next time, stay smart, stay safe, and keep growing. Bye bye.